makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. Happy Friday, June the 28th. I'm Tom McKenzie here in London. Here's what's coming up on today's programme.
We created 15,000 new jobs. We brought out the position where we have 800,000 new manufacturing jobs, but there's more to be done. There's more to be done.
The only jobs he created are for illegal immigrants and bounce-back jobs, a bounce back from the COVID. He has not done a good job. He's done a poor job.
Democrats express alarm at Joe Biden's performance in the first presidential debate, fanning concerns about his age. Meanwhile, Donald Trump brings energy as well as falsehoods and exaggerations. European stocks climb along with US futures ahead of the Fed's preferred measure of inflation due later today. Plus, European leaders nominate Ursula von der Leyen for a second term as president of the bloc's executive arm. So yes, European stocks are posting modest gains after 3 days of losses. The French markets, though, solidly in negative territory as we lead up to the first round of voting in that parliamentary election on Sunday, with the national rally of Marine Le Pen still polling in first place. Gains coming through here in the UK, a bit of a pickup in terms of the commodity story. On a sector-by-sector basis, you have autos and basic resources at the top of your sector list. In the red lane, though, you can put L'Oreal, and that is dragging down consumer products, given challenges in the China exposure for that company. S&P futures currently pointed to gains of 0.2% as we expect that PCE price indicator out of the US to edge lower for the month of May to 2.6%. That would be the lowest print that we've seen since around March of 2021. US futures, as we mentioned, pointing to gains. The Nasdaq futures pointing up by 66 points. Let's flip the board and look cross-asset then. You had a bit of a rally in terms of treasuries yesterday on the back of some softer cooling data out of the US on the economy there. 429 though today, currently flat on the benchmark. 328 is where we're looking in terms of the French 10-year, and of course the spread above 80 basis points versus German bunds, and we will continue to monitor the risk premium for French debt and French equities as well, leading into that vote, of course, on Sunday, and then on the back of it. Euro dollar at 106, a little bit of softness coming through, down a 10%, largely down to the stronger dollar, and that was partly down to what was happening in terms of the presidential debate. The dollar gaining, and expectations from some, at least in these markets, that was a win that came through for former President Trump, and possibly that could signal stronger US dollar in focus. Talking of which, let's unpack that debate then. President Joe Biden stumbling through exchanges in the first presidential debate of this cycle, a performance that risks exacerbating concerns among Democrats about their candidate's ability to defeat Republican Donald Trump in November's election.
Making sure that we continue to strengthen our healthcare system, making sure that we're able to make every single solitary person eligible for what I've been able to do with the COVID. With dealing with everything we have to do with. Look, if we finally beat Medicare.
The only jobs he created are for illegal immigrants and bounce-back jobs, a bounce back from the COVID. He has not done a good job. He's done a poor job, and inflation's killing our country. It is absolutely killing us.
OK, let's bring in Bloomberg's Kriti Gupta, who watched that debate for us. We see the stumbling there from the current President Joe Biden, but also the mistruths, as we said, the exaggeration coming through from former President Trump. Talk to us, we'll get into the substance, but talk to us about the style, the concern within Democrats on the back of this debate, Biden not performing as many would have hoped.
So there was a high bar for both candidates, and for Biden it was he needed to physically and mentally show that he was not only competent, but he could endure standing for 90 minutes without any sort of hiccups. Clearly from that shot, that was not achieved. On the other hand, President Trump also had something to prove in that in his last debate, he was criticized for being argumentative, interrupting, and of course going over his time, something that the debate moderators tried to address with things like muted microphones. And even with that, President Biden actually went over his time more and had to use the muted microphones on him more than President Trump did. All in all, it came out and looking like President Biden just wasn't able to show up to the opportunity. And on the back of it, now reports coming out that the Democratic Party is actively concerned about their representation this election cycle.
And possibly considering as well a different candidate. with all the complexities that might go into that. And maybe that's going to be a short-lived mood within the Democratic Party. They have the September debate as well, and plenty more before that. In terms of the substance, where and what stood out to you from what we heard from the two candidates, particularly when it comes to the economy of the US and national security, issues like Ukraine?
Well, I'll start with the economy of the U.S. The very first thing on the new president's docket is going to be the deficit issue. January 2025, they have to deal with that, and that is going to be a big concern. Now, the way that they deal with that couldn't be more different. Tax cuts and hikes are going to be very top of that agenda. Joe Biden, for example, talking about funding that deficit gap, narrowing that gap by actually increasing wealth taxes on the wealthy, making over $400,000, saying they need to be paying their fair share, and then having longer-term plans like chip manufacturing, drug pricing, extending the parts of his policy that are already in play. On President Trump's side of the equation, you have the exact opposite, talking about tax cuts to stimulate the economy, but then also using that as encouragement for corporations like Apple, which is a company that he named, to repatriate some of the funds, in addition to loosening some of the regulations around things like oil and gas, for example. Tariffs, of course, also coming a part of that conversation. The tougher you go on China, Trump claims, the easier the deficit will get.
Krissy Gupta, thank you very much indeed. Anchor, of course, for Markets Today, with the detail on that presidential debate and the implications in terms of the policy and the style as well. Let's bring in at this point Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs, for a view on the market implications, the political risk more generally. And Peter, I'll start with you on this question. Are you starting to see, do you expect to see risk premium being priced into US assets as we lead up to that November vote? How do you expect equity markets to adjust to the elections of the US?
Well, Tom, I think the context here is important. Everybody's known that this is the year of elections, the largest number of people in history voting. But the markets really found it very difficult to pin anything on that. You know, what would be the economic or indeed market-moving implications? And what we've seen unusually is very low volatility and rising risk assets. But we're really now starting to see this debate becoming front and central. We've already seen some surprising outcomes in elections this year, Mexico, India, others, and of course the early election called in France, the UK, and what we're seeing now in the US. So I think the focus is very much now on politics, and I think we're starting to see that in slightly higher volatility. Our own risk appetite indicator, for example, which was at very elevated levels until recently, has started to fade. I think that's all part of this issue now becoming a real central focus for investors. OK,
so maybe a tick up in volatility around some of this. And we'll bring you onto the European space and the views around the political risk in France. But before we do, one more on the US. There does seem to be a view coming through. You can take the view that whoever is in office, tariffs are going to be a central tool and remain a central tool, and the dislocation of these supply chains. What is your advice to those looking across their portfolio, looking to tariff-proof their portfolio?
Well, it's interesting, actually. What we've seen in places like Europe is internationally exposed companies doing rather better, but those companies which have production or facilities already in the US, so they're somewhat protected potentially from tariffs. And actually more domestically exposed things have done better in the US on the basis that they'll get further support as these developments unfold. But I think this is a reflection of some larger structural changes which investors are having to grapple with as well. You know, we've seen a period of uninterrupted globalization for many, many years, coupled with extremely low interest rates and very, very low trade barriers. And in recent past, of course, trade barriers have increased. We're likely to see more. We are seeing a bit more fracturing of the globalized model, more localization, regionalization. And this also feeds through, I think, into issues like high government debt and therefore higher, longer-term interest rates, at least relative to what we've been used to in the last decade. And that all, I think, support strong balance sheet, high-quality companies that have production facilities in places like the US.
OK, well, and that takes us also to some extent to what's happening in terms of European conglomerates as well. I was speaking to JP Morgan's Karen Ward yesterday. She says she thinks that European markets have oversold on the French political risk. She's seeing opportunities, for example, on French banks. I said, would you be buying? She said, yes. Would you agree with that? Are you looking at opportunities given the sell-off that we've seen?
Yes, I think two things I would say. First of all, you know, the French market has been hit more than the rest of Europe. And this hasn't, as yet, represented itself in anything like the sort of systemic type of risk that we were seeing, for example, during the sovereign debt crisis. I mean, French banks have been hit. Domestic stocks in France have been hit quite hard as the risk premium has gone up. But Italian banks, for example, are up 35% year to date. And actually, the banking sector's the best or the second best performing sector in Europe. We like the banks because they have strong balance sheets, they're cash generative, they're paying dividends, and buying back stock. And some of this, I think, is oversold. It's also just worth mentioning that in France, if you look at the CAC 40 index, only 15% of the revenues of that index are domestically exposed in France. So it is a very global index of companies. Like many of those in Europe, it's dominated by very global companies.
And in terms of hedging for political risk, you flagged one sector that comes top of mind for you, which is healthcare. What are the hedging characteristics of healthcare?
Well, healthcare, I think, is interesting on two fronts. First of all, it is a relatively defensive sector in the sense that it's less sensitive to changes in economic activity or indeed interest rates. And in that sense, I think it's attractive. But also, I think it's potentially structurally attractive as a major beneficiary of AI. Now, we've seen a huge amount of attention on AI for good reason. But if you look at industries which can adopt and utilize these technologies to improve productivity, drug discovery, new products, I think that's one that we would find interesting.
Policymakers and others suggesting that AI is going to have a catalytic effect here in the UK as well in terms of productivity. We've seen some economic data out today out of the UK suggesting it's a little bit more robust than maybe some had expected. The first quarter, 0.7%. Your views on the UK then? Does the UK become... We have our own elections, of course, this time next week, on Thursday of next week, but different dynamics at play. Does the UK become something of a haven? How do UK assets perform in this environment?
Well, I think two things worth saying here. Firstly, the UK has had a very unusual period of political volatility in the last decade relative to at least its longer-term history. And it looks as if you've got more centrist policies and quite significant on either side of the main contesters for the election, very similar fiscal plans, or at least fiscal constraints. The market sees that as relatively benign in terms of potential shocks. But also, UK assets are very cheap.
The markets are right to see that as well?
Yes, I think that's right. Certainly in the context of some of the things that we're hearing and learning about in other markets.
And as a result, do you see a pickup in flows into UK
Yes,
assets?
and certainly interest. The UK market is very cheap, I think. It trades roughly at about half the PE ratio of the US, the biggest discount we've seen in around 30 or 40 years. Now, some of that, of course, reflects the fact that it has very different exposure in the index relative to the US. But even if you adjust for that, it looks very cheap. It's a very cash-generative index. If you look at the free cash flow yield, it's pretty much the highest of any major market in the world. Companies are paying decent dividends. And there's a lot of, I think, attractively valued companies. Part of the problem is the lack of domestic support and liquidity, less exposure in equities of pension funds and insurance companies. But nonetheless, I think there's arbitrage opportunities in the UK. And we're finding a lot of investors are actually really quite interested in it.
Very interesting. Peter Oppenheimer, thank you very much indeed. Chief Global Equity Strategist at Goldman Sachs, on how to position in this politically volatile environment, possibly less volatile here in the UK. Coming up, talking of politics and volatility, EU leaders backing Ursula von der Leyen to stay on as Commission head. Not a big surprise there, but the horse trading behind the scenes has been pretty fascinating. More on that deal next. This is Bloomberg. Welcome back. Investors remain on edge ahead of parliamentary elections in France. This is the country's three main party leaders squared off in the final television debate ahead of Sunday's first round vote. Let's get more from Bloomberg's opinion writer Lionel Laurent in Paris. Lionel, talk to us about the debate, what came through for you, and how we should be thinking about this first round vote on Sunday.
So this has been a very short campaign, not really enough time to get into policies, and given that we had a first debate only 2 days ago, I don't think the debate itself really is much of a game changer. I think Macron's party would have had to pull a huge rabbit out of the hat, and even though it was definitely feistier against Bardella, who's Le Pen's number 2, it's Le Pen's party that's still the one to beat, and their lead is widening. The more that they kind of try and drop their most toxic policies, their lead keeps going up. So I think that tells you that actually we still see exactly the same positioning that the polls predict. Le Pen's party is the one that's top, and it's the one to beat, and it's probably not going to get beaten.
And then, briefly, we move on, of course, to the second round. How much political volatility is there between the first round and the second round, typically in France?
Well, this is totally uncharted territory. This is why you have to be very careful. It's the first time we'll have the incumbent or the establishment in third position, and the far right and the far left and left bloc in number 1 and number 2. The problem is if you're in third place, you're in the worst position. So I think that's why you should be cautious, but really expect potentially the far right to do even better than we think, getting a high majority and maybe even an absolute majority, because there doesn't seem to be much appetite for a proper Republican front where everybody rushes out and votes for whoever is opposed to the far right.
OK, Bloomberg Opinion's Leonard Laurent with the preview of that really crucial parliamentary vote coming through on Sunday, of course, for France. Thank you. More broadly across Europe, the European Union and its leaders have nominated Ursula von der Leyen for a second term as president of the bloc's executive arm. Let's get more from Bloomberg's Oliver Crook. Ollie, the top 3 jobs now confirmed by the leaders within the EU, but it's not over yet.
Yeah, Tom, this was pretty well advertised, so maybe not too many shocks there, but there was some pretty interesting things happening under the surface. So just to recap, Ursula von der Leyen basically re-elected, endorsed by the member states in order to take another 5 years as the Commission president, Kaja Kallas to take the foreign policy role, and then Antonio Costa to take the the Council of the European Union. Now, these are important jobs to get nailed down because from this, all of the other portfolios sort of emanate going downwards. And so this was sort of a victory lap for the center that is sort of held within Europe. Others were not as pleased about it, such as the leader of the ECR party, now the third biggest party in parliament, and we know Giorgia Meloni, the leader of Italy. Have a listen.
I do not support, and I have never supported this agreement. Just as I announced yesterday in Parliament, I think this is a big mistake, and I find it disrespectful towards European citizens and their vote. I believe I respect the will of European citizens by not supporting this deal.
Non sostenendo questa proposta.
And so Meloni abstained from the vote. Viktor Orban, for once, voted against von der Leyen. So you have sort of a flavor of how some of these national politics are now sort of playing out on the EU stage. If you think about kind of where, Meloni's left her options open by abstaining, maybe supporting her, von der Leyen still needs to get through the MEPs, the European Parliament, more than half of those votes. Without Meloni's support, that becomes a razor-thin margin. She only won by 9 votes last time. It gets more complicated this time. And when you think of the national politics playing out also for the French and the Germans, who tried to sort of change the policy agenda late last night, and basically the other member states said no way, really illustrating how the two most sort of powerful countries within Europe have really lost their clout since the EU election and really sort of lost that sort of domestic support.
Bloomberg's Oliver Crook on the ground for us in Brussels on how the domestic politics of countries like France, Germany and Italy are feeding in to a changed dynamic at the EU level. Ollie, thank you. Plenty more coming up. Stay with us. This is Bloomberg. Welcome back to some of the other top stories on the Bloomberg terminal this Friday. Ukrainian President Volodymyr Zelensky has signed a long-term security commitment with the European Union. The deal formalises EU initiatives to support the war-torn country, including arms deliveries and training Ukrainian troops. Polls open later Friday in Iran's presidential election to select the replacement for Ibrahim Raisi, who was killed last month in a helicopter crash. Two of the most conservative candidates have stepped aside ahead of the vote, strengthening the chances of two other hardliners. And Delhi Airport has suspended all flights from Terminal 1 after a part of the forecourt's canopy collapsed early this morning following heavy rain. Delhi Fire Services says one person died and another 7 people were injured in the incident. Switching focus, and let's check in on a corporate story of the moment. Nike coming through with an earnings update that disappointed the markets, and you can see pre-market that stock is down 14%. We've seen the read across to European retailers like Adidas. They've been challenged in terms of the lineup and demand for their shoes, and particularly as well the Chinese market has been a concern for Nike. And you can see pre-market then that stock down 14%, but there is a broader read across from that story within the sector. Let's quickly look as well at a deal that's come through for the telecoms equipment maker Nokia, one of its biggest deals, in fact the biggest deal since it took over Alcatel-Lucent, paying and coming through the deal around $2.3 billion for Infinera. That's a US-based company in pre-market. That stock rallying more than 19%. Coming up, more on the UK elections. That is next. This is Bloomberg. Democrats express alarm at Joe Biden's performance in the first presidential debate, fanning concerns about his age. Meanwhile, Donald Trump brings energy as well as falsehoods and exaggerations. European stocks climb along with US futures ahead of the Fed's preferred measure of inflation due later today. Plus, European leaders nominate Ursula von der Leyen for a second term as president of the bloc's executive arm. Good morning and welcome to the Pulse. Happy Friday, June the 28th. I'm Tom McKenzie here at our European headquarters in London, checking in on the markets for you. As we have mentioned, European stocks eking out some gains after 3 days of losses. S&P futures also in positive territory, nosing higher by 0.3% ahead of that price gauge. The PCE index, crucial of course in terms of the way the Fed is thinking about the evolution of inflation in that country, expected to come in at 2.6% in terms of core. And to what extent does that tie into expectations around the first Fed cut, with markets now pricing in about 45 basis points of cuts by the end of this year? Cross asset 430 on the US benchmark 10-year yields just up 1 basis point. There was a move into treasuries yesterday on the back of some economic data that showed a bit of cooling in terms of the US economy. In France, we continue, of course, to adjust the risk premium as we lead up to that first parliamentary vote on Sunday. 329 on the benchmark 10-year, and the spread over German Bund still plus 80 basis points. 106 on the single currency, currently a little softer by 0.1%, and that is largely down to dollar strength. Now, JP Morgan is adding Indian government bonds to its emerging markets index. The move set up India to lure billions of dollars in extra inflows and open up a $1.7 trillion market to a broader range of investors. Global funds have already poured close to $11 billion into index-eligible bonds since JP Morgan's announcement in September. Staying with the region, let's discuss the green investment outlook now for India with the country's largest renewable energy company, Renew. CEO Sumant Sinha joining me now on set. Sumant, thanks so much for coming in, and welcome, of course, to the studio. Really appreciate it. Let's talk about we've been talking about the politics of France, the UK and the US, of course, today, but the politics of India, we're still working through the ramifications of that, the surprise lack of a significant majority for President Modi, Prime Minister Modi, I should say. Is there a political risk now as you look ahead in the months and quarters ahead for your business? Is there less policy certainty than there was a couple of months ago for you in the business in India?
No, I don't think so, Tom. I think the elections were, of course, fairly long drawn out, but the result was something that was a little bit preordained. Of course, people didn't expect the Prime Minister to lose his absolute majority, but nevertheless, with allies, he's pretty strongly in the saddle right now. And I think that is reflected in the cabinet that he's chosen, which is very similar to the cabinet that he had earlier, with most of the same ministers holding the same portfolios. And I think the clear signal to all of us in the business community from the government is that this is going to be business as usual, and the same policies will continue. And that, as you know, for businesses like ours is very good to hear, because we make long-term investments, and that policy predictability and continuity is very important. So, frankly, I don't see that there's going to be any significant change from the last government to this government. The Prime Minister is the same. The policies are going to remain.
Interesting. Okay, so you're confident that you get policy certainty, and as you say, crucial in your sector where you're making those long-term investments. How do you see, what are the policies that you're expecting and looking for that may adjust the environment for your sector? How does the renewable sector in India adjust in the years ahead?
Yeah, look, I think the government's target has been always very clear that we want to get to 500 gigawatts of renewable installed capacity by 2030. And
is that still achievable?
I think it is. So look, the reality is that India's power demand is growing very, very significantly. The economy itself, as you know, is growing very significantly. And the government has taken one fundamental policy decision, and that is that all new power demand growth should be met from renewable energy capacity. And that will require us to add almost 70 to 75 gigawatts of new renewables just to meet the power demand growth. Now, there's a very strong commercial reason for it as well, which is that renewables is cheaper than the alternative, which is coal-based power. So it's both in India's economic as well as climate interest to essentially add as much renewables as possible going forward from here. And so we have to achieve the target of 50 gigawatts at the very least.
Yeah, OK, so 500 gigawatts is the target by 2030, but on an annual basis, missing it so far. You're confident you get there by 2030. What have been the headwinds to the installation, the progress around installation?
Yeah, so I agree with you that we've been adding at about 15 to 20 gigawatts a year till now. But I think one significant thing that happened last year was that the government actually stepped up the amount of auctions that they do. And that is the sort of step one to getting a larger amount of capacity executed. So last year, the government actually auctioned 60 gigawatts of new renewable capacity. And that, therefore, we will start seeing that coming into the market in terms of executed capacity a couple of years down the road. So I think what's going to happen is we're going to step up from 20 to 30, 35, 40, and eventually 50 to 60 in the next 2 to 3 years' time. Now, what are the constraining issues? Of course, there are several, right? First of all is land acquisition. Mm-hmm. Land acquisition is never easy. A lot of the Indian land holdings are very fragmented. You have to deal with hundreds of farmers to get a single 300 megawatt project of wind or solar executed. So that always requires a lot of effort. The second thing, of course, is the transmission build-out. Is that going to go fast enough? And there the news is good. The government is really ramping that whole transmission build-out up. The third is capital. Fortunately, right now, especially with all the money that is going into the debt markets in India, I don't see debt as being a constraining factor. And as you know, Indian equity markets are doing very well right now. So I think equity should also be available.
OK, so capital isn't a challenge. Land remains complicated. We are seeing evidence that some distribution companies are still reluctant to commit to these long-term purchase agreements with companies like yourselves. What is holding that back? As you say, that power demand is soaring in India.
Yeah, no, that's a good question. I think part of it is just simple governance. We've also just had the elections, which have just sort of finished a month or so ago. And everything was a little bit on hold for that. Now that elections are passed and power demand is going up, we are seeing more and more PPAs getting signed. So in our case, for example, we had won about 8,000 megawatts of auctions last year. Roughly about 2,500 of those PPAs have already been signed. And we're hoping that the rest of those will get signed this year as well. So I see that eventually all of that power demand growth will, via these distribution utilities, start transmitting itself into PPAs getting signed and more bids coming in.
Is one of the stumbling blocks the fact that some of these companies still have these legacy deals with coal energy providers? Is that a factor?
Yeah. No, I don't think so. I think the bigger issue is, the coal PPAs were there for up to a certain amount, but of course, as power demand grows, they need new incremental capacity to come from somewhere. I think the issue more is that a lot of them are owned by state governments, and they still run as state government departments. And that reform, by the way, is one of the most significant reforms that is left in India's power sector going forward.
How do you see, you talked about transmission, how do you ensure that your projects, your future products, are synchronized with that transmission?
So, there's a very transparent mechanism of allocating the transmission capacity that is being built out. So once you win a bid, you essentially know which are the available substations, you apply with the letter of award that you get, and you're guaranteed to get access into the grid. So, for example, for all of the 8 gigawatts that we have won last year, we've already got connectivity for all of those. So we know exactly where we're going to do those projects and where they're going to connect into and what the natural, the radiation is and so on and so forth. So we have very high predictability around our future set of the next 10 gigawatts of projects that we're going to be doing. But that's how the system works. And if you want to get into an area where there is no transmission substation, you can actually just go there, acquire land, and then get the government to build out the infrastructure, which then will typically take 4 to 5 years. But there is a very good system in place for building out the transmission infrastructure.
How are you thinking about the data center growth that we're seeing all over the world for things like artificial intelligence? And India has a crucial role to play. Lots of talent, lots of data. data centres being built out in India. Is that a growth area for you in terms of supplying those data centres, which are incredibly energy hungry?
Yeah, look, that's a great question, and I think that's something, in fact, that I get more and more from investors. And the reality is we will have a lot more data centres getting built out, and so that will become a pretty significant part of demand growth that we're going to be seeing over the next several years of 7 to 8%. Electric vehicles are also going to contribute to demand growth as well, because there's a pretty rapid shift now towards electric vehicles happening, not just four-wheelers, but also two-wheelers and three-wheelers, and eventually public transportation and mass transportation will also go in that direction. So there is a lot of demand growth that is fed by a lot of these structural factors. What we are seeing is we are not just doing deals with US tech companies or Indian tech companies for the India operations and India data centers, but also for offsetting their global carbon footprint. And so they're coming into India and buying carbon offsets from us for offsetting their global carbon footprint. And that's actually leading to its own level of demand, for us, with very good, high-quality off-takers and very large-sized transactions. So, for example, we signed a 450-megawatt PPA with a very large US tech company for their global carbon offsets.
Very interesting. Sumant Sinha, thank you very much indeed for coming in, CEO of Renew. It is India's largest renewable company, listed in the US as well, on how the renewable sector in India is evolving and the demand picture. And Sumant was talking about the demand around electric vehicles. We have a redhead crossing the terminal right now. This is a Chinese company, privately held, but also a big producer of electric vehicles, rivaling and competing with the likes of BYD. It's Geely Auto coming through with first quarter net income well above the income print that came through year on year. So 1.56 billion yuan versus 714 million yuan that we saw in terms of year on year is the number. So it seems a significant first quarter net income coming from Geely. This is the owner of Volvo Cars, by the way, as well as the likes of Lotus. Geely Auto then, with net income in the first quarter of 1.56 billion yuan. Coming up with the UK election just days away, we will find out how markets are positioning. I'm going to speak to prominent investor Burnbrae's Jim Mellon on why he is bullish on UK equities. This is Bloomberg. Welcome back. The UK election is less than a week away, with polls showing Keir Starmer's Labour Party heading for a landslide win Thursday next week, while Prime Minister Rishi Sunak's Conservatives face a wipeout after 14 turbulent years in power. There's been no sense of panic, though, in the UK asset markets so far, particularly UK equities, with the FTSE up around 7% this year. Relatively modest, of course, versus the S&P, but still in positive territory. The pound also trading at around 126 to the dollar. And, of course, we should note that these are just polls. We will find out the result, of course, on July the 4th, July the 5th. And that is the test, of course, as to whether or not the polls are getting this one right. Meanwhile, prominent investor and Brexit supporter Jim Mellon is among those who are bullish about the UK market. Joining me now from the US. Jim, thanks so much for taking the time. Does the equity story for the UK and the relative resilience, very relative resilience that we're starting to see here in terms of the growth picture, does that hold up if we get a majority Labour government from July the 5th?
Oh, I think so. I think it's going to be more of the same. You know, Labour's come out with some fairly reassuring points for both business and for its economic policy. And there's definitely momentum in the UK economy. You saw that the first quarter GDP figures were revised upwards again this morning. And there's no doubt that the UK is doing better than a lot of its peers. And I think that's largely down to the fact that it's a service economy, and service exports and services in particular are booming at the moment. So it looks very good. And then when you contrast that, Tom, with the fact that it's the cheapest developed market in the world and that there are vultures circling many of its companies, you have a combination of potential significant upside relative to other markets. So I'm very bullish on the UK, not just because I'm British, but because actually internationally it looks like the most attractive market.
Very interesting. It chimes with what we heard from Peter Oppenheimer of Goldman Sachs earlier on the show, who was saying and pointing to that valuation discount of around 50% broadly, UK equities versus their US counterparts. To what extent do you think private capital is going to be and continue to be a catalyst for these markets. We look at PE, for example, buying companies here like Darktrace. It seems like the private markets are seeing value where arguably the public markets are not quite yet.
That's absolutely correct. I think one of the reasons is that UK pension funds have run down their holdings of equities dramatically over the last 20 years, and they only hold about 4% of the UK equity market now. So any encouragement to bring pension funds back into the capital markets will be, I think, very gleefully received. But of course, private equity and other buyers are very interested in the UK, and I think the bid for Britvic is a good example of that by Carlsberg this week. And I have been looking at companies that might be acquired by private equity or indeed by industry competitors from domestically and internationally. But I'm also encouraged that there are more companies coming to the UK market. So as companies leave the market, there are new ones going to be coming. So as you know, the UK market has regained its position as the largest market in Europe. And I think it's only got one way to go, which is upwards. We're looking at about 9 times next year's earnings on the FTSE 250. That compares to 21 times for the S&P 500 in the United States. The dividend yield is considerably higher. And for offshore international investors, there's no dividend withholding tax, unlike in the United States, where it's 30%, and elsewhere, where there's significant dividend withholding taxes. And there are some very attractive companies with dividends attached.
I was going to ask, I want to get into your views. I want to get a peek, Jim, into your list shortly. But broadly, on the index, because you mentioned the FTSE 250, do you want to be buying, which of the, if you're buying on the index level, are you buying FTSE 100, FTSE 250, the small caps? If you have a preferred index, where do you land?
Well, that's a very good question, because as you know, in the FTSE 100, a very large percentage of the revenues come from overseas. It's somewhere around 70%. So it's a very different composition to the domestically reflecting index, which is the FTSE 250. Personally, I would buy the discounted investment trust with good management, low management fees for the smaller cap to medium-sized cap companies. And then in the big ones, my focus at the moment is actually on telecoms and on financials, because I think both of those areas look even more undervalued than the rest of the market. But you've got a cornucopia of choice, basically. But I think that go for the actively managed funds, which are selling at discounts on the market for the smaller companies, that you don't have to pour through all the annual reports. And then on the bigger ones, I've got a selection of companies that I'm very interested in.
Jim, I'm looking. So you talk about telecoms. On the list that you sent us, BT is on there. We've got change at the top, of course, a new CEO of BT. And on the banking space, within the banking space, you've got Lloyds as well. So this clearly, you underscore, this is a value story, but as well, is it with the banks, for example, is this a buyback, a return to cash story? And to what extent is dividends a theme for you in terms of the upside that comes through with exposure to companies like BT and Lloyds?
Well, one of the great things about the US market in the last 10 years has been the significant levels of buybacks and the financial engineering that's resulted in rapidly rising earnings per share. And I think the same thing is coming to the United Kingdom. In financial services, the banks are beginning to get the idea that buybacks are a good idea. And whereas Lloyds' management is somewhat lacking, they managed to attract every single scandal that's going. They are generating very significant cash flows, and indeed those cash flows are going to grow. So my estimate for 2027 is that Lloyds will be yielding about 8% respectively. It's on around 5 times earnings, and it's the absolute dominant player in the UK mortgage market, which looks okay to me because housing is going to be a big positive feature of the economy going forward. So Lloyds, yes, I think is a good value play, and they will also be buying back a lot of their own stock. In terms of other banks that are interesting, the HSBC story, I think, is very good. They have excellent management, in my opinion, and they are going to be generating very significant cash flows and buying back their stock at a very rapid level. And they're also a play on emerging markets in a sort of sanitized way. Both China and Hong Kong are very significant parts of their earnings. So those are 2 banking stocks I think you can buy with some confidence.
Interesting. And, of course, change at the top of HSBC as well, with Noel Quinn announcing that he will be stepping down, at least at some point. Look, you touched on this, so before we let you go, Jim, you talked about the watch list you have for potential takeover targets. Can you give us a glimpse as to what that list, or what is on that list, Jim?
Well, I like Phoenix, which announced this week that it was trying to sell, or was going to sell, inviting bids for its Sun Life subsidiary. Phoenix is the largest aggregator of what you might call zombie life funds, including Standard Life, and also of pension funds, buying them in from companies that want to get the pension funds off their balance sheets. It's got about a 10% dividend yield. It's got reasonably good management. I think it's an ideal target for private equity. And if they run off the books, they could make a lot of money. So 3 or 4 times, in my opinion, of future cash flows, 10% dividend yield, reasonable balance sheet. I think it makes it a very juicy target. And it's a big company. It's about £5 billion in market cap.
OK, really fascinating. Really appreciate your time this morning. Jim Mellon, Burnbrae chairman, of course, Burnbrae chairman, Jim Mellon, on the calls around the telecom space, the bank space as well, and the bullish call on UK equities. Coming up, Nike shares tumble pre-market after the world's largest sportswear company issues a full-year outlook that misses expectations. As you can see, pre-market, the stock down 14%. More on those earnings next. This is Bloomberg. Welcome back. Nike has tumbled pre-market after a full-year outlook that missed expectations. The world's largest sportswear company sees revenue declining in the mid-single digits in the current fiscal year. Let's get more then with Bloomberg consumer goods reporter Dasha Afanasieva. Dasha, what is going on and what is going wrong with Nike?
Hiya. So Nike had a bad earnings update on all sorts of parameters. Not only did it miss expectations in terms of revenue and some profit metrics, it's also massively downgraded its full-year forecast. Now, the core of the issue is that just its shoes aren't popular anymore. The particular problem area is lifestyle shoes. So this is things like Air Force Ones, things that you wear day to day. And they've just kind of, it seems, gone out of fashion. And I think the concern is the timeline of this turnaround, because, Nike had issues all through last year. This isn't the first quarter. And now the CEO is saying it's 25, fiscal 25, which we're in now, that is the turnaround. And you sort of think, well, why is it taking so long? And part of that is innovation, that, they've got to think of, get an innovation pipeline where throughout the year they're coming up with new products that can compete. But part of that is also marketing. You do wonder, are some of these brands just stale, particularly Converse?
OK, Bloomberg consumer goods reporter Dasha Afanasieva on the challenges for Nike and its lineup. Thank you. Checking pre-market in Finera on the back of this news that Nokia has come through with a plus $2 billion bid for this company. The stock then pre-market up almost 19%. Up next, Bloomberg Brief with Danny Berger and Manus Cranney. This is Bloomberg.